Welcome to CoreLogic's housing market update for July 2022. Our National Home Value Index recorded a second consecutive month of decline in June, down 0.6% to be 0.2% lower over the June quarter. Continued falls in Sydney and Melbourne were the primary drivers of this month's steeper drop, but housing values were also down in Hobart and in regional Victoria. Every capital city and broad rest of state region is now well past their peak rate of growth as the trend of value increases eases across the remaining markets. National housing values have been easing since moving through a peak in March last year, when early drivers of the slowdown included rising fixed-term mortgage rates, an expiry of fiscal support, a trend towards a lower consumer sentiment, affordability challenges and tighter credit conditions. More recently, surging inflation and a rapidly rising cash rate have been additional headwinds for home values. Since the initial cash rate hike on May 5th, most housing markets around the country have seen a sharper reduction in the rate of growth. Looking below the headline capital city trends, the combined regionals index remained in positive growth territory in June, albeit slightly, rising only 0.1%. Its quarterly value change reduced from a peak of 6.6% in April last year to 2% over the 3 months to June. In contrast, the combined capitals index was down 0.8% over the June quarter, reducing from a peak of 7.1% over the 3 months to May last year. Also, unit markets are holding their value a little better than houses across the largest capitals. Sydney recorded a 3% drop in house values through the June quarter, compared with a 2.1% fall in unit values. Melbourne also showed a smaller quarterly decline in units relative to houses at 0.5% and 2.4% respectively. The stronger performance across the unit sector comes after house values consistently outperformed units through the upswing. Since the onset of the pandemic in March of 2020, capital city unit values have risen 9.8% compared to 24.7% for houses, resulting in better affordability across the medium to high density sector. As housing conditions slow, we're seeing the market swinging back in favour of buyers. While national advertised stock levels remain 6% lower relative to 2021, in Sydney and Melbourne, where housing conditions are the weakest, total advertised supply is now well above levels recorded a year ago and higher than the 5-year average. Hobart has seen advertised stock levels jump 54% higher relative to last year, and inventory is 19% higher in Canberra. The rise in advertised supply across some markets is mostly due to a slowdown in the rate of absorption. Nationally, home sales were down 16% in the June quarter compared with the same period last year, but still holding 13% above the previous 5-year average. Tougher selling conditions are evident in weekly auction results, where the combined capital city clearance rate is held below 60% since the last week of May, while private treaty sales are experiencing longer selling times and higher levels of vendor discounting rates. On the flip side, rental markets are doing the opposite of housing values. Rental conditions remain extremely tight around the country, with rents now consistently rising at a faster rate than housing values. Nationally, rents increased 0.9% in June, taking the annual growth rate to 9.5%, the highest 12-month change in rents since December 2007, when record levels of overseas migration pushed rental demand higher. At the national level, rents have been rising faster than housing values for 5 months now, placing renewed upwards pressure on yields. After bottoming out at a record low of 3.21% in the first 2 months of 2022, the average gross yield has increased to 3.33%. With rental markets expected to remain tight, it's likely rents will continue to outpace housing values, driving a rapid recovery in rental yields. Higher yields may help to offset less demand from investors, although this sector of the market is generally more motivated by prospects of capital gains rather than rental returns. Brisbane's rate of growth in housing values has eased sharply, reducing from a quarterly trend of 8.5% through the December quarter to 2.7% in the June quarter. The monthly rise was just 0.1% in June. If this trajectory continues, we're likely to see Brisbane housing values declining on a month-to-month basis through July. Growth conditions are cooling more noticeably for houses than for units. Over the quarter, Brisbane house values are up 2.5%, compared with a 3.5% rise in unit values. As the market slows, the number of home sales through the June quarter was estimated to be 7.5% below the same period last year. Less demand has also flowed through to a consistent rise in advertised stock levels, along with a rise in average days on market and higher vendor discounting rates. Australia's housing market outlook is becoming increasingly skewed to the downside, with the trajectory of housing values heavily dependent on the path interest rates take. While forecasts vary significantly, it's entirely possible the cash rate could rise beyond the pre-COVID 10-year average of 2.56%. Under this scenario, the average variable mortgage rate for new owner-occupier loans will be approximately 4.9%, more than double the 2.4% average variable mortgage rate back in April, adding roughly $720 per month to a $500,000 mortgage or $1,445 per month to a $1 million mortgage. Households are likely to be all the more sensitive to rising interest rates due to the record levels of debt held by the sector. Household debt-to-income ratios from the Reserve Bank indicate debt levels reached a new record high in the March quarter. The ratio of household debt to disposable income was recorded at just over 187%, the large majority of which was held in housing debt. The double whammy of high inflation is another factor likely to weigh on the household sector and ultimately housing demand. Non-discretionary inflation is rising at more than double the pace of discretionary inflation, which means households are likely to be saving less as they spend more on essentials such as food, fuel, and shelter. Lower savings and higher expenses, along with rising interest rates, will have an ongoing impact on borrowing capacity for households. Reduced borrowing capacity is likely to further diminish housing demand and potentially deflect more buyers towards the middle to lower end of the pricing spectrum. Higher interest rates and rising inflation are also both likely to continue to weigh on consumer sentiment. Housing activity and consumer sentiment are highly correlated. A pessimistic mindset amongst consumers implies a further reduction in home sales. If sentiment remains subdued, we're likely to see the number of home sales drift lower as housing demand cools and lenders become more cautious in their approach towards borrowers. How far housing values fall through the downturn remains highly uncertain. However, a peak-to-trough decline of more than 10% is becoming a mainstream outlook across the various private sector forecasts. A 10% decline in the market would take national housing values back to levels similar to July of 2021. A 15% decline would take the market back to April 2021 levels, and a 20% decline in home values would take the national index back to January 2021 levels, and only marginally above where home values were in late 2017. Strong labour markets will be a key factor in supporting mortgage repayments and keeping distressed listings off the market. Generational lows in unemployment alongside a record high participation rate will help households to meet their debt repayment obligations despite rising rates and high inflation. A key risk for housing markets would be any material loosening in labour markets, which could be triggered if the cash rate moves into a contractionary setting, reducing economic output. A substantial accrual in borrower repayment buffers is another factor helping to safeguard the housing market, estimated to be 21 months for owner-occupiers on a variable rate mortgage, meaning most households have a significant safety net if temporarily faced with a change in their circumstances. Mortgage stress should also be minimised to some extent by mortgage serviceability assessments at the time of the loan origination. Under these serviceability scenarios, it's reasonable to expect borrowers should be able to accommodate higher mortgage repayment costs, although such a rapid rate of inflation could create some challenges for borrowers on thinly stretched budgets. Clearly, the housing market is changing rapidly as rising interest rates and inflation, along with low sentiment and ongoing affordability challenges, dampen housing demand. You can stay up to date with all the key trends by checking out the news and research pages at CoreLogic.com.au.